Thank you, thank you. Uh, Thanks, Jeanette. Thanks, TradeThirsty, for putting us on this event. If you are here today, you are obviously serious about making money because there's so much other stuff you could be doing right now. I mean, I know there's going to be football games, or were they yesterday? I don't even know. And there'll be football games tomorrow, and there's golfing and skiing and 1,000 other things you could be doing. But you're here, um, which is awesome. So thanks for showing up. Anyway, guys, what we're going to talk about today is what I truly, and this is not just a marketing headline, this really truly is what I believe to be the hottest trading opportunity of the decade. And just to kind of get you in the right frame of mind. So a lot of the stuff that I do throughout the day, throughout the week, throughout the month and the quarter and the year is talk to my colleagues in the hedge fund community, family offices, people that I've worked with my whole life, really. A lot of those guys are also my clients now, and we do stuff together. And so a lot of the stuff that we are actually everything I'm about to show you here is stuff that we together as a think tank with all these people do together, and this is a trade that you're about to see here that I know for a fact that some of the very best traders in the world have on. These are not necessarily people that you know of. A lot of these guys are a little bit more, I'm going to call it secretive, for lack of a better term. I don't like that word, but more secretive kind of hedge fundy kind of people and family offices, and they have this trade on in size. So this is not a quick, chart chasing sort of day trade. This is what we call a trend following trade, and so that's what we're going to talk about here today. Now, basically, just to give you a sort of basic backdrop before we dive into this into depth, is sort of the backdrop of globally slowing growth, right? This has been going on for some time. It's not really showing any signs of abating. We've had some temporary relief, which I'll get to literally in just about 10 seconds. But we've seen a lot of signs here that things are continuing to slow down. That'll probably continue in the next year or two. But I have a question for you guys. Does anyone know why we've had such a sharp rally in stocks over the past month and a half or so? Anyone have any wild guess? Well, here's a chart for you, okay? And I'm going to start off with this one. This is a chart from the Bloomberg terminal, and the blue line is your simple S&P 500 line, right? That's a simple chart chaser S&P 500 line in blue. What's much more important is that little white line, right? That little white line is what we call the Fed's balance sheet. So the Fed basically started to unwind its balance sheet somewhere in the second half of 2017, and October the 12th is one of the most important days of the year, every year actually, not only because it's my birthday, but this year because that's when the Fed started to basically increase its balance sheet again. Now, I think it's very difficult to disagree with what this chart is telling you, right? So you can see the Fed basically increasing its balance sheet again, which basically leads to risk-free, beautiful, everything is awesome kind of markets. Now, trust me, there's no coincidence why the Fed started doing this. Thank you for the birthday wishes, guys, and you guys are all correct. All of you that are typing this in, Pablo, Bob, Anthony, and 15 other people typing this in here, you guys are absolutely correct. It is indeed because of the Fed came in. Now you have to think about this. I want you to think about this with an open mind. So I should also say, as we look at this stuff together, I really want to take you guys on a journey. This is not about me fear mongering. Anyone that's followed me before, and I'm sure Jeanette would agree, I'm not someone that's out there trying to fear monger. I'm trying to just give you a little bit of perspective on stuff, right? In the markets, it doesn't pay to be optimistic when or it doesn't pay to be one-sided. You have to really be open to all opportunities. So I'm just trying to show you what I see here. And again, I'm not trying to scare you or fearmonger. The point is just I'm trying to show you some research. But I want you guys to think about this. And this is just the beginning of the tip of the iceberg before we start really working into this. If the economy is really doing so unbelievably awesome as everyone thinks and seems to say, why the hell, excuse the language, is the Fed all of a sudden going in and doing this quote unquote non-QE, which really kind of is QE? I want you to really think about that. Yes, they're saying, oh, it's because of Europe. Excuse, Europe is slowing down. Europe has actually been doing marginally better over the past few months. It's not. Trust me. They're trying to basically fiddle things together, right? So again, and I also want to be clear. This is not at all anything that we look at here is not at all any political statement. I do not do politics personally. It has never paid, at least in my 21 years as a trader and investor, to do politics and trying to make money from that in the markets. It's about understanding and following the data. Yeah. So if you do have different views on the markets, by all means, that's not at all to belittle those views that you have. I'm just trying to show you some data, my research, and what I definitely think is the hottest trading opportunity of the decade here. So is that good? So with that in mind, let's have a look at some stuff here. What are we going to talk about? So first of all, we're going to have a little bit of a data check, right? So a lot of the stuff that I do is really dig deep into data, global economic data and other stuff, cross-asset analysis. And so what we're really going to look at here is the weakening economic backdrop that's been taking place, or that is taking place still right now. Then we're going to look at some charts. So we're going to look at those economic data points in charts. And then we're going to go into really what is by far the most important market out there, which is the bond market. And then, of course, we can look at what the actual trade is. So by the time that we're done here today, you guys should have a really good idea of what this is and how you can make money with it. So here's the situation. If you just kind of take a step back, I'm going to call this, I call this the WWH, right? Not to be confused with WWF, but WWH, which is the what, the why, and the how. And I also want you to understand that what we're about to look at here is not something you need to just go out literally right now or a Monday morning and start putting on some trade because you need to make money within the next week or so. This is a trend following trade of serious magnitudes that I expect to be something that can be stayed on and put on for probably the next couple of years, So let's talk about the what. So the stock market, and we look at global equities. We're not just going to navel gaze at the S&P 500. That's too simplistic an analysis. The stock market has generally been trading very choppy, although to be clear and to be sure, marginally higher, at least the S&P, since early 2018. And investors, and you wouldn't know this by listening to your popular financial media outlets, if you dig a little bit deeper and listen to people that are in the know, investors are getting increasingly frustrated and increasingly concerned. So talking about the why, well, global economic growth continues to slow. We've seen a bit of a stopping of the slowdown, or a slowing of the slowdown of the past couple of months, month and a half, but it's definitely not over. Trade war uncertainties may be one thing, it's just one thing. But again, it's just the economic cycle. After 10, 15 years, things do start to ultimately slow down, and bond markets have been rallying, certainly if you look at US bonds and if you look at European bonds. The how, well, how could you possibly take advantage of this late cyclicality of the U.S. economy and other economies? You could potentially de-risk, start selling some stocks. That's one thing one could do, right? It's one thing one could do. I suppose if you're really aggressive, you could short stocks. That's always a bit riskier, but it's one thing I suppose one could do. Or you could just do what some of the most successful traders in the world do. I've seen these very, very successful hedge funds and people I talked to do this twice already in my lifetime, and I can tell you they are literally knocking the cover off the ball. Like, it's not even funny how much money they make with this trade, and it's a vastly superior trade than what you can do in the equity market with a lot less volatility. But let's go into some data here. So here's the thing. If you look at, for example, the ISM manufacturing data, we in August had it in the US fall below 50, which is basically means contraction, right? Now, this is not usually a linear thing. Usually you see bounces along the way, and I think we're having a tiny bounce right now, but that's kind of what's going on there. If you look at October data, and I'm trying to show you as much diversity in data, so you can see that I'm not trying to cherry pick, right? I'm not trying to cherry pick, so I'm trying to show you as much different data from around the world so you can see that. Same thing here, if you look at October 3rd data, ISM and non-manufacturing data, same kind of idea below 50 here. Then you can see something like the data here. Basically what this is trying to tell you is that, same data, but again, stuff going lower. Than in Europe, the same situation. You can look at something like the German economy, which basically technically is technically in a recession, just so you guys know. And they just I think a couple of weeks ago, something like that, they just basically printed a marginal flat GDP, but really I'm pretty sure they actually massaged that. So basically we have negative GDP in Germany. Eurozone as a whole is seeing continuously or continuingly weakening manufacturing data. Switzerland is manufacturing data well below 50. That's Europe. How about in China? Let's just to kind of go around the world. How about in China here? Well, you can see something like industrial production here, which is continuously going lower. You can see retail sales also going lower. Again, not trying to cherry pick, but showing you a diverse set of data. On October, I forgot what the date was, but in October, China printed a GDP of 6%, which is basically a 30-year low. Yeah. So again, I just want to be clear. I'm not trying to fear monger. I'm just trying to show you a bunch of data points so you can kind of see all this stuff come together, right? So don't take this as something trying to go out there and fear monger, make you scared, and be all fantastic, sort of over exaggerating. I'm just trying to show you some data points from around the world. So that's China GDP. Then you can go into something like US markets. So this is total market capitalization versus US GDP. And you can see the last time we were at these points that we are right now was basically at the top of the internet bubble, if you will. So we are at 150% total market cap to US GDP. If you can't contextualize that, if you don't know exactly what that means, you can look at the chart, and the chart tells you that's obviously a fairly lofty level to be at, historically speaking. Digging a little bit deeper, you can look at things like auto loan delinquencies, right? So auto loan delinquencies are basically now at a level they last were at in October of 1996, and that continues to basically go higher. Consumer loans are still soaring, right? So basically we're seeing more debt buildup, which is part of the lower rates. But what's really interesting about that part is that credit cards are actually charging sky high rates, even though interest rates, as I'll show you in a minute, are actually going lower. So you can see interest rates over time are going lower, but credit cards are charging close to 9% interest on average. Now you have to think about this. Why are credit cards charging such high interest rates? Maybe they know something. Maybe they know something, but about the consumer potentially getting a little bit weaker here going forward. Just maybe, right? It's just a suggestion. Again, not trying to fear monger, just trying to show you some data, and I hope you can see I'm showing a fairly diverse set of data here, right? So we've looked at some weakening economic data. Then the next thing here is to look at some charts. Are you guys with me so far? Give me a quick yes if you can kind of see where we're getting at here. Give me a quick yes. Again, I'm not trying to scare you. I'm not trying to be fantastic about things. I'm just trying to give you some data, and I really mean this in honest to God. It's just what I'm seeing. If stuff gets better, then by all means, we're going to get all bullish on things again. Yeah. Okay, good. So I'm getting a lot of yeses. So let's have a look at some charts. So what we're going to do together right now is we're going to go into the market and we're going to look at the data points we just looked at and see if we can look at some simple charts that we can kind of make sense of. So the first chart we're going to look at here is basically I took the New York Stock Composite Index. Ticker symbol is NYA for most for more chart services, and what I did is I overlaid it with the German DAX. Now, I'll be clear, these two indices have had very nice rallies over the past couple of months, but I want you to see that basically we're only back at where we were in early 2018 right now. So we've basically gone sideways for a prolonged period of time, basically 2 years. You wouldn't know all that if you looked at the S&P, because the S&P is an index that's comprised rather differently than some of the other ones. It's very heavily weighted in a few heavy mega cap stocks like Microsoft and Apple and so on and so forth. But my point I'm trying to make, if you just take a step back and then go away from the S&P, you'll start to see things a lot less strong than you might think if you just glance at the S&P. Speaking of the S&P 500, this is a chart that I've been telling or showing our clients now for the past, I think, 2 quarters. And basically what you're seeing is we're starting to trade. This is a pure technical chart, but first of all, from a momentum perspective, we still are making lower highs in the RSI. It's a simplistic way of looking at it, but just so you guys know. The second thing is this kind of, we call a broadening top or a megaphone pattern. And basically, we're at the very, very, very upper end of this pattern right now. And ultimately, again, this is not my base case. I'm not saying the equity market crashes, but one has to think that right now there probably isn't all that much more upside left if this is the pattern that we've been in for the past 2 years or so. So that's a simple S&P 500 chart. In fact, what's really interesting is that stocks, the S&P 500, would be about 20% lower if it weren't for the stock buybacks. So stock buybacks have been a significant portion of the rally, and we would be about 20% lower if stock buybacks wouldn't have been there. So that's interesting to know, because I think stock buybacks are about to start slowing dramatically, and they've been a major proponent or sort of bid underneath the market. You can compare this here. Basically, what we're showing in this chart is that if the stocks that had buybacks versus those that didn't, there's a huge difference here. You can see the ones without buybacks have risen 300%. The ones with closer to 500%. So anyway, just so you guys kind of know, again, it's just I'm never going to be opinionated about stuff. I'm just trying to show you data, and I hope you can see that. The US dollar at this point in the cycle, it's actually having a big rally today. If you look at it versus the euro or something like the Swiss francs or the dollar index today is having a fairly good move. The dollar being strong at this late point in the cycle is actually not very good for the economy. And we're going to get to this a little bit more in a little bit, yeah. So just keep that in mind. Commodities had a bit of a bounce over the past couple of weeks or so, but if you look at a bigger picture, you scale the chart back a little bit, we're sitting on a cliff, right? Again, I'm not saying we're going to completely fall apart, but it's not exactly the kind of chart that gives me the warm and fuzzies, right? Same thing, or on the other hand, you have gold, right? So gold here is the chart in blue, and the dollar index is the chart in yellow. And so what you can see is that gold year to date, not for the past 2 weeks or the past month and a half, but year to date has had a good rally, and that's been taking place in spite of a strong move in the dollar. So that's actually very unique. You don't often see a strong move higher in gold or a notable move higher in gold while the dollar is also having a bid. And that's actually a very rare occurrence. Basically, what it's telling us is that there's real buying taking place in the price, in gold, essentially, right? So that's an important thing to understand. Then high yield bonds, another really important part of the market. This is a really important part of the market that I think a lot of people don't pay a lot of attention to, but to me, arguably the one thing that's going to be able to have us give us a real heads up. You can see high yield bonds, which is credit. Basically, this is like bonds of lower quality companies, I guess, for lack of a better term. That was my background for many years in working in credit and that kind of stuff. And so that's interesting to know, because high yield's at a really critical spot. Yeah. In fact, what we've seen over the past couple of weeks, and we've seen a bit of mean reversion over the past few days again, but we're starting to see some more near-term divergence between stocks, or the S&P 500, which is algorithms chasing, Apple going vertical. That's kind of the same thing. Versus high yield bonds, we're starting to see some divergences. So this is very near term, but just so you guys know, that's what's going on. Also very near term, there's something called the OIS, or LIBOR versus OIS spread. Does anyone know what that is? I don't want to make things too complicated, but this is a really important thing that I watch all the time. Basically what this is, this chart here is giving us basically the credit risk that's in the market. So LIBOR is the banking, is what banks charge each other overnight for lending on reserves. But OIS is basically with the central banking interest rates. So if LIBOR starts to go higher versus the OIS price, basically that starts to give us a bit of a clue that there's more stress in credit, meaning it's a warning sign. To make it very simple, it's a warning sign, right? It's basically what this chart up here is telling us, the high yield chart, but it's showing it to us in a bit more of a sophisticated manner. Does that make sense? I'm just trying to give you guys an idea and give you some more insight than just looking at, you know, something way too simple, like looking at a chart breakout in Netflix or something like that, which is nice to know, but ultimately you're not going to make a, you know, you're not going to make a crazy money with that kind of stuff. This is I think what's much more important stuff. So I'm glad you guys can appreciate that. European banks, just to kind of mix things up a bit more, they have had a bit of a rally over the past couple of weeks as you know, Fed stimulus and central banks and blah, blah, blah. But for the most part, these things are still looking awful. And those negative interest rates, which I'll get to in a minute, are not exactly helping there. So here too, and by the way, this chart looks awfully similar to, this looks awfully similar to the chart of commodities, if you guys remember a minute ago. Over in Asia, just so you guys know, I just did this chart this morning. Here's the Hang Seng. Hong Kong basically was down today after some overnight news. This is a multi-year chart, and I mean, I don't know about you, but this is a simple technical analysis chart, but you can see we're kind of bear flagging here. If you're, you know, someone who's a bear flag pattern drawer, you know, I call them chart doodlers, then you can probably appreciate that this, unless there's a major reversal here, doesn't exactly look super positive. Same thing in the Shanghai Composite. This is a more near-term chart, 2019, but you can see we're starting to break down a little bit. It's a very near-term chart, but again, not the kind of chart that gives me the warm and fuzzies through looking through the lens of the next couple of months or something like that. Some of the best performing stocks in the S&P 500 year to date are Dollar General and Walmart. And obviously, we've had a fairly good rally this year, so this is not to take anything away from that, but these two stocks are rallying as well. And you know, if everything was so super awesome, you wouldn't see, particularly the dollar stores, you wouldn't see them act well. I know we've seen some divergence in other dollar stores over the past couple of days, but for the most part, again, this is a bigger picture point. So I think you guys can see what I'm getting at. Also, utility stocks. Does anyone follow utility stocks? You know, like your utility stocks, I guess it's just what they're called. Pretty big rally in utility stocks this year, right? If everything was so awesome, you know, utility stocks on average don't go vertical like this. So, and this slowly gets us into the more important. And just by the way, another thing here is, yes, and real estate too, exactly. Here is some really interesting stuff. Here is U.S. stocks outperformance versus European stocks since the 1950s. So this goes back a fairly decent amount of time. And you guys can see that right now, US stocks are like, I don't know, more than 2 standard deviations above the norm, right? So usually they oscillate between 1.5, you know, sort of standard deviation. Right now, this is where US stocks are versus European stocks. So I think right now chasing US stocks is risky, right? So that's just one thing I'm looking at. Are we good so far? So now we've looked at some data, we've looked at some charts to kind of make sense of all this stuff. So now we're going to go into what I think is probably the most important part of the presentation. So if you're clicking around on your screen and you're Black Friday shopping, or you're texting around, or whatever else you're doing, or snacking on some turkey, just bring your attention back to the chart. This is, or to our screen here. This is really important. So these are messages from the bond market, and I can't really overstate the importance of this stuff. So I would urge you to pay some attention if you could. So is an economic recession inevitable? Well, you have to understand that economic gravity is a natural phenomenon of economic cycles. So a central bank can only sort of bend economic gravity for some time. And in fact, it's important and healthy to have economic slowdowns. I'm not trying to say that this is, you know, there's always going to be hardship, and that's really sad, and so this is not trying to belittle all that. I'm just trying to give you the sort of the more economist way of looking at it. And Thank you, David. I appreciate the commentary. But I think what it's really important here is to understand that we shouldn't even be afraid of this from a market perspective. Yes, it sucks if stocks go down and you have no way to get out of them because you have no perspective. But it's important to understand they're a natural part of things, and no central bank can stop those things forever. The problem is that the longer the sort of central banks try to stem these things, and you just saw that chart here. I'll go back to this chart. You guys saw what happened once again a month and a half ago on that really important day, October 12th, my birthday. But that is really important to understand, that the central banks continue to play this game, but at some point, the game of musical chairs basically stops. And then what happens is the markets tend to react rather quickly. Like, for example, in the last quarter of last year, the markets reacted very quickly and it was pretty ugly. And so that's important to understand. Now, central banks will always react rather quickly, but then they'll start to fall behind. And I think what's happening right now, and this is absolutely no disrespect to Fed Chair Powell, I actually had the awesome chance to have a few words with Fed Chair Powell. True story. I'm not making this up. In September, he was speaking, and I had a chance in Switzerland, so it was easier to access him. And so I think what basically the Fed is doing is they're kind of behind the curve right now. And so you'll see them oscillate rather swiftly between hawkish and dovish. And I think ultimately they're going to end up having to cut rates probably more than people think next year. So that's just a bit of an idea there. Now, what all this means essentially is that we've had this race to zero in interest rates. And I don't know if you guys are aware of this, but interest rates in Japan have been low to negative for a long time. And in Europe, as you guys will see, that's been going on as well. And so why are global bond yields falling? You have to ask yourself that question. It's a really, really important underpinning phenomenon that's been taking place. And it's the most important thing, and it's ultimately going to come. That is going to come back and haunt the markets once we get through this fake QE, whatever they call it, and maybe past a potential trade deal version 1 and all those kind of things, right? That's a lot of that is kind of headline news and noise making, as opposed to what's really underpinning the markets. So I made this little timeline, and if you guys want to, you can take a picture of this chart with your phone. Maybe you I don't know, maybe you have a camera. I literally just got back and I bought an iWatch. I think it even takes pictures. So if you have one of those, I'm not even sure. If you have one of those, you can take a picture of it. But this is important. So I'm going to walk you guys through. I'm going to take a couple of minutes to take you guys on a bit of a history ride on interest rates. We're going to look at 10-year U.S. Treasury yields starting in June 2007. So in June 2007, I was sitting at my trading desk in London at JP Morgan, and what I was doing, I saw a lot of signs that things were about to get pretty ugly in the economy. And at that point, the 10-year yield was at 5.3%. This was the peak of the housing bubble. Things were happening. We at JP Morgan were trying to offload bonds to clients mostly in Europe, because they were the only ones that still believed this miraculous housing story. And so 10-year bond yields were at 5.3% at the time. And so I was a credit default swap trader, which is one of those things that really saw a lot of the stress happening. Ultimately, kind of the stress really started to kind of weigh on everything. But 10-year Treasury yields then in January 2009 were at 2%. So just so you guys understand, like the bond, for the bond market to go from 5.3% yield to 2%, that's like the S&P going in half or more. That's a huge move. Like, it's crazy big. And a lot of people can't contextualize that because they're just chart chasing their latest favorite, breakout pattern or whatever they look at on the charts. Which, by the way, I'm not trying to belittle that, by the way. So I shouldn't say it that way, because I do that as well. We also do some trades, a lot of trades actually. But this is the stuff that really matters. So by January 2009, where the depth of the stock market crash was, the 10-year yield had gone from 5.3% to 2%. Well, we then continued to see, we had a bit of a bounce, and then the economy started to slow again, and then the 10-year yield was at 1.4%. The economy picked up again, and by October 2018, so about 13 months ago, the 10-year yield in in October 2018 was at 3.2%. And I don't know if you guys remember, but in October 2018, so just about a year ago, basically, people were screaming and dancing and saying, oh, 10-year yields are going to 4%. And I can tell you right now, I must have lost, I don't know, 10, 20 customers in October 2018 when I told people that I think yields are going to go back down below 2%. I'm on the record for this. And funny enough, none of those customers came back because they're probably ashamed of themselves. So just when everyone was screaming and yelling that yields are going to go to 4%, they went down to 2, right? So basically now here we are in November 2019, and we're at 1.75%, and 10-year yields are right about right now. We were as low as I think 1.45 or so in 10-year yields just in September, just about 2 months ago or so. Yeah, so the point I'm trying to make is that there's a trend. Now, this is only the near-term trend. Just wait until you see the next few charts, which are crazy important to understand. Are you guys with me so far? I need to always check in with you guys because these are important charts. Give me again a quick yes. I don't want to give you carpal tunnel by typing in too many yeses, but it's important you follow this stuff. Yeah, good. And again, if you haven't taken a picture of this yet, or at least a mental picture, I would encourage you to do so. Awesome. Thanks for the. I want to make sure you're not Black Friday shopping. You need to focus on this, guys. This is going to make you money, hopefully. So here's another chart, and here what we're looking at is we are looking at yields basically in the in Europe, right? And so you might be thinking, oh, who cares about Europe? Well, it's not that big economy. Well, it does matter, and it does matter because we have globally interconnected economies. And so what you see here is I just took a sampling of basically different countries, and you can see France, Denmark, Austria, Netherlands, and you'll see that these yields have gone from positive to not just zero, but negative, right? So I don't know how many of people are aware of this, but think about what a negative interest rate is. It's insanity. Like, it makes no sense on any level, and it's crazy. Anyway, it's crazy. That's the point. Now, I want to show you something super crazy. I'm in Switzerland right now, and here's the craziest chart that I've ever seen. This is a yield curve. I don't know how many of you have ever seen yield curve before, but this is basically the maturity of different bonds, and you can see the zero line is up here. And to be honest, I made this chart about a month and a half ago, something like that. So it's a little bit out of date, but not much. You can see that if right now you bought a bond in Switzerland, you would have to pay the government 2%. Excuse me, 1%. 1%. Think about that. It's crazy, right? So, but that yield curve isn't negative just the first 2 years. It's negative to 50 years. So you can buy a 50-year bond and it's negative. So it's completely insane. And I know this may be a bit new for people to get their mind around, but it's nutty, right? And here's the totally nutty chart. This is basically showing us how much negative yielding debt we have around the world. And again, this chart is a couple months old, but we're looking at a big picture thing, so it doesn't really matter. But basically, I think it's about a third of global debt is negative, so about 16 trillion in bonds is negative yielding debt. But I'm trying to tell you there's a strong trend of bond yields going lower, okay? I want you to just keep that in mind. Now, you don't have to really believe me, right? I'm a nobody, but you can listen to Alan Greenspan. Do you guys know who that was? Big Al, he used to be at the Fed for, I don't know, I think he was there for like more than 10 years. He said, and you can go and watch this on CNBC if you want, and I quote, "It's only a matter of time," he said this on September 4th, so a couple of months ago, "It's only a matter of time before negative rates spread to the US. It's not me. These are not my words, okay? So believe it or not, these are just his words. Just so you guys know, I'm not quite sure rates will go negative in the US, but they can certainly go much lower. Now, one of the things that Al focused on when he said that is basically the demographic issue, right? So basically, the world population is aging and people are living longer, so there's an immense demand for bonds. Maybe some of you are retired or soon to be retired, and you're probably looking to buy more bonds, right? Or at least maybe your investment advisor is telling you to do that. So, anyway, that's a major thing structural thing in addition to the whole global economy is that there's an immense demand for bonds, so yields to go lower, bonds to go higher. Christine Lagarde, does anyone know who that is? She's the head of the ECB, recently just inaugurated. She also thinks rates could still go lower, right? Now, really interesting here is if you compare yields on the U.S. Treasury, so you take 10-year U.S. yields, which are right now at about 1.7%. They were closer to 1.4%, like we said before, and you compare that versus the equivalent 10-year bond in Germany, which is negative 0.35. That's more than a 200 basis points, more than a 2% differential in rates. I don't think that's very sustainable. I think ultimately what's going to mean basically is US rates are going lower. And I want you to think about this as well, food for thought. If the United States is genuinely the safe haven when it comes to bond yields, like the US 3-month Treasury note is considered like to be like the ultimate safe haven, right? So if the US is the safe haven of all safe havens, why are yields like the highest or some of the highest in developed countries here right now in the United States? It doesn't make any sense, right? It's completely reverse. They should be the lowest, right? So that doesn't make a lot of sense. We have a flat to inverted yield curve. I'm going to skip over this in the interest of time, but here's where it really gets interesting. This is a 30-year chart. This is a chart stretching back to the late 80s of 30-year Treasury bond yields. And I think anyone can see there's a trend here, right? Would you guys agree there's a trend, right? So yields are going lower, and right now they're kind of cliffhanging. Remember that movie, by the way, Cliffhanger? Yeah. So if 30-year bond yields go lower, just to the low end of this range, we could easily get to 1 or 0% in 30-year yields. And again, I'm not making this up. This is a simple, stupid, simple 30-year yield chart, right? So it's lower. Yields are going lower, bonds are going higher. How about on 10-year Treasury yields? Same thing, this stretches back to the 80s. In fact, it goes even further. If yields go to the low end of this channel, I think everyone can draw a channel probably, right? It's a couple lines on a chart. You're talking about yields being able to go at least 0, potentially negative 1%. And to be clear, I'm not saying this can happen tomorrow. This is a trend following trade that I think is going to play out over the next quarters and years, not tomorrow. So don't go out there and buy bonds and expect, Monday, the world's going to collapse. But this is a trend following trade that's, I think, existentially important to be aware of. And here's what really gets nutty. 2-year Treasury bond yields. If 2-year Treasury bond yields go to the low end of their trend, they can go down to negative 4%. It's not my base case. Let me be very clear. It's not my base case. I think that's crazy. Although we thought negative rates in general were crazy, right? But so just to be clear, but yes, 2-year yields, if they go to the low end of the channel, we're just doing the same exercise we did in the 10-year and the 30-year, right? Now we're doing 2 years. They could definitely go negative, let's put it that way. Again, it's not my base case, but I think they could definitely go 0. I think everyone could see that 0 is not that far-fetched, right? So having said all that, like we said before, 30% of global sovereign bonds have negative yields. And so basically what's happening is people are taking on more and more risk as an alternative to this because they're getting paid less and less in bonds, but they still have to buy a lot of bonds. And so there's a massive desperate search for yield. And this desperate search for yield is pushing people not only into riskier investments, but also more and more into treasuries, because global yields, like you guys just saw, at least in Europe and in Japan and other places of the world, are very low or negative. So in the US, they're still positive, but I don't think they're going to remain as positive as they are right now. Does that make sense? So to me, what this is really all about is about protecting yourself. If the economy continues to slow, then corporate bond buyers are going to leave, and the stock buyback programs stop, which we talked about earlier being a very important part of the market. And so the risk is that corporate bonds and stock markets start to deteriorate just as the baby boomers hit peak retirement rates. This is really important to understand. So if you want to protect yourself, I think buying bonds here still makes a lot of sense, even though yields are so low. And so another way to think about this is your pension fund, right? Some of you probably may have pensions from a company you've worked at or something like that, or maybe you have your own company that has a pension fund for your employees. And so if rates are generally going lower and lower over time, again, this is over time, this is not tomorrow or even next week or even next quarter necessarily, just over time, then I think it's important to understand that a pension fund that buys a lot of bonds, which all of them basically do, and let's say the pension fund has an assumption of being able to make you, I don't know, 5 or 10% a year. I don't know what they are, it depends on the fund. How the hell are they going to achieve that if bonds are trading at 1% or lower, or even where they are right now? They can't do it, right? And this is already a problem. Just go ask some pension funds in Europe, or even look at Chicago and other parts, other pension funds, right? Are you guys still following me? This is really, really important, and I'm not making this up or fear mongering. I'm just trying to show you some data that I think is important to understand. So with all this in mind, let's talk about how the hell can we make money from this? Yeah? How can we make money from this? So we just talked about this base case of mine, and I'm not trying to be opinionated. Again, this is just about potentially how we can make money. If interest rates go lower in the US, what that means is that bond prices should go higher. So if you're new to bonds, then here's how it works. So if interest rates go lower, so bond yield goes lower, bond price goes higher. It's an inverse relationship. You guys with me? So it's if you're betting that bond yields go lower, what you should be doing is buying bonds, right? That's the simple takeaway. So there's 3 ways of the way you can do this. Or actually 4 plus ways, and I'm going to walk you guys through them. Number 1 is you can just buy some US Treasuries, right? That's the simple trade across the curve. I don't care if you buy 2-year bonds or 10-year bonds or even 30-year bonds. If the base case remains that bond yields go lower, i.e. bond prices go higher, it doesn't matter where along the curve you buy, right? This might be a bit boring for you, and it is a little bit boring, but it's the basic trade, the basic sort of mechanism, right? Now, the good news is if you don't want to do that, you can be a little bit more frisky, and you can buy like an ETF. You can buy like an SHY or a TLT, right? So trade idea number 2 then would be you just buy the ETF that's the SHY, that's the shorter end of the yield curve, or TLT. I think either works. I don't have a huge preference of one over another. I think maybe the short one is better, but it doesn't matter. If rates go lower, these bonds will go higher. Right? Here's the chart of the ETF, so you can kind of see what this looks like. Yeah. So this is trade idea number 2. So instead of just buying treasuries, you can buy an ETF, right? You can do that. Thirdly, if you wanted to lever things up a little bit, you could maybe buy some options. And I want you guys to know, this is not, don't quote me on these option prices. The option prices move. These were option prices from, I think, yesterday or something like that when I pulled them. But this is an example, okay? So don't go out and send me a nasty email tomorrow and say, oh, you misquoted the options price by $0.015. No, that's not the point. Okay, this is a bigger picture chart. So with TLT trading at around $140, which God willing, I think is roughly speaking where it trades now. Okay, what you could do, it's an idea. You could buy a June 2020 call, a simple call, right? A simple call. And right now that would cost you about $5. About $5. So the profit target price that I have in TLT for the foreseeable future, maybe at some point next year, is about $150. So if bond prices go higher and rates go lower, then basically an investment of $5,100 in that option could make you $6,000. So that's more than a double of your money. All right. And the great thing about this, as you'll see in a minute, is much less volatility than what the equity market has. Why would you do this trade? Again, it's a ton of money to be made. You can hedge your portfolio and your retirement, and I think that latter part there is really, really important. And it's a trend following trade that the pros are doing. And by the way, it's like I said, much less volatile than the stock market. Make sense? Now, there's another way you can do this. And this is where it gets interesting for some people who like to be even friskier than that. You could use an investment of, say, $360 and make $3,600 using something called Eurodollar futures. These are interest rate futures. These have nothing to do with currency. I know the name is confusing, but they have nothing to do with currency. And the great thing about this futures contract is it's got no time decay. It's a smaller investment than if you were to buy an ETF or treasuries or even options. And I know, so five or six maybe of the very best traders that I know, super successful hedge funds, they have this trade on. They've had it on now for about 6 months. Okay, and so that's what's going on here. Here's probably the most important chart I can tell you. Guys, please pay attention with this chart. Take a picture of it, do a screenshot, whatever you want to do. This is probably the most important chart I can show you. This is Euro-dollar futures, which look at it like a bond. It's basically acts like a bond, right? It's price. It's not yield. It's price. So if look at the last 2 times we had an economic downturn. Let's call it a recession. One was after the dot-com bubble burst, and one, of course, was the depression we had in 2008, 2009, 2007, 2008, 2009, right? About 6 months before these economies really turned down, we had a ginormous move in these Euro-dollar futures, which is, again, they're bonds, right? And I think we're once again at a point like this right now. This is probably the smartest chart I can show you right now. Okay, I'm not saying it's going to work out. I don't know. I don't have a crystal ball either, but I've just shown you charts and giving you examples over the past 50 minutes. So I think you can kind of make sense of this. Are you guys with me so far? Give me another quick yes, because I'm going to show you how you can do this together. No, so these are Euro-dollar futures, right? And I'll teach you much more about this going forward if you want to do this with me. But basically, the ROI potential looks like this. If you invest 360, you could potentially make 3,600 with Euro-dollar futures. That's a 10x return. Or if you invested $500, you could potentially make 5,000. If you invested 10,000, you could potentially make 100 grand, right? Again, there's no guarantee in this, but there's no guarantee in anything. There's no guarantee of anything. Right? But it's something that I'm just giving you a very honest bit of research on. Now, what I did is I have some of my I am advisor to a couple of big family offices, and well, a whole bunch of those kind of outfits. And I've been doing this trade with them now for the past 6 months in this research. But I've had a lot of people on our retail community side asking us if they could participate. So what I did is I basically made them a report. The report is basically these slides. But what I'm doing now is I'm doing webinars every month and a video update every month. So twice a month, I update you guys on this trade. And it doesn't matter whether you want to do buy the bonds or you want to buy the ETF, or whether you want to buy options, or whether you want to buy Euro-dollar futures. Each trade we cover. So I'll tell you exactly what we're doing and how to adjust it and everything. So basically the way it works like this is if you want to just get the report itself, which is basically these slides, and we keep updating them every month, that would be about $500. The ongoing market sessions, which is also the video, is $997. And all of this is good for 1 year. So we do this one time for 1 year, basically. Now, the total package value here, because we're also including my most successful and our most sought after and our best selling indicator, which I'll show you more about in a minute. It's called the beat to reversal indicator. This total package value is $1,991, and because it is Black Friday today, we're going to give you an 85% discount on this so it's $297. It is limited to the first 100 or the next 100 subscribers. And I think Jeanette's typing the link into the chat box or other places. You can see the link right here at the bottom of this page you're looking at right now. It's www.thesteadytrader.com/deal. So instead of paying close to $2 grand, you could today on this Black Friday pay just $297. It's just a one-time payment. It's not a monthly fee, none of that. We basically do this for 1 year. So it's like a one-time deal. So we're gonna do it from now for 1 year, and then every single month I will make a video, and also a couple of weeks later, I make a live webinar. So it doesn't matter who in here wants to do the trade by bonds. Does anyone want to do it by bonds? Does anyone want to buy TLT? Does anyone want to do Euro-dollar futures? Who wants to do options? Type in how you would like to do the trade. Type in TLT or bonds or options or Euro-dollar. I'm just curious how many people, what would you like to do? Because it doesn't matter which you want to do. We're going to cover it in these live webinars and then the videos that we do. Yeah. But again, I need you guys to understand this is not a day trading trade, right? This is a trade, this is a trend following trade that we're looking to keep on for, quarters and at least for 1 year, because we're going to do this together for 1 year. Make sense? So don't freak out when something goes against you intraday or intra-week or intra-month. It's a trend following trade. Now, let me quickly sidebar to the indicator. We're going to give you our best selling indicator as well, the B2 reversal. The B2 reversal indicator is something that we're going to use also how to manage the range in these bonds, but it basically prints these arrows on your chart. Let's see here. So this, for example, is a signal that we just got in Alabama a couple of days ago on the B2 reversal indicator, right? And the stock has basically gone straight higher since then. And the indicator just prints arrows on bullish and bearish reversals. So here, for example, we've got a sell signal and the stock dropped. Sell signal, stock goes lower. Buy signal higher, sell signal lower. You get the point, right? So that's our B2 reversal indicator. So we're going to include it here for Black Friday today. And if you guys are interested, you're going to get it here for one hell of a deal for just $297. And we can go on and on with these examples. I think you guys get the point, right? There's also a scanner for it, just so you guys know. Let me quickly go up to this. And it'll work for Thinkorswim. It'll work for TradeStation. It works for eSignal, and it works for NinjaTrader, and also it works for TradingView.com. So that's, and also of course works for our Market Rover. But basically, there's 4 scans for it. So all we do is we look for opportunities. Let me quickly bring a chart over. Give me 1 second, just so you guys can see this. So you click on just one. Oh, I have to bring this over. So you just literally click on the chart, on the ticker, and then you get the signal. So every day you get opportunities for this. So if you guys want that indicator as well, today we're basically including it in the package here for a Black Friday special. Make sense? So I only have, I think, about 5 minutes left. Let me see here. Let's see, if stocks crash, wouldn't gold be better? Well, it's just a different way. Like I'm just to be clear, Dan, I'm not calling for a stock market crash. I'm calling for bond yields going lower over time. That's not necessarily one and the same. Just to be clear, I do think stocks are very, very, overbought, but I'm not calling necessarily a complete disaster in the stock market. That's not necessarily what I'm calling for. In fact, the stock market on average could actually hold up to some extent if you're talking about high quality dividend stocks. So anyway, let me see other questions you guys have. So again, today this is just $297 for the Black Friday pricing. You guys like this? All right, great. What is the TradeStation symbol for this instrument? I don't know. I don't know what the TradeStation symbol is. I really don't know. You have to call TradeStation. But again, so here's how it's going to work. So if you are interested in this, you can go ahead and get it. Now again, it doesn't matter whether you want to do this trade via futures, or if you want to buy TLT or SHY ETFs, or whether you want to buy an option on those. Any of those work, we will cover each one of those trades, right? So what's going to happen as soon as you do this here and you get this, and again, it is limited to the first 100 subscribers, and just want to make sure you understand that. What's going to happen is you're going to get access to this, right? So you're going to get an email sent to you with an access code to the website, and I can show it to you guys quickly. Let me quickly show it. So you're going to get access to this page here, and then on this page, you'll be able to go to courses, DTTS reports, and then you'll be able to log in, and then you see the reports and also the video. So they're all recorded here. They're all hosted here. So here's the video, for example, from November 12th, October, blah, blah, blah. All these, they're all here, right? So you can watch them all. And of course, we also email you the recordings as they go out. So everything's there. So we always update you on this. So like, for example, on November 12th, just to give you guys an idea, on November 12th, what I did is I sent out a video, as you guys can see right here. It's time stamped. And what we did is we told people that bonds are oversold, okay? So if you take TLT and you look at November 12th, that was here, and TLT has since rallied about 4 or 5%. That's a big move in bonds, okay? So that's just so you guys know. Again, I hope you can see that. Some of the questions on the B2. The B2 works on any asset class. It works on stocks, bonds, equities, whatever you want. It works intraday as well. And also, since you're getting this, you will be invited to live B2 reversal indicator member sessions we do at least every other month. So with the indicator, you're also going to get live sessions that we continue doing, we've done them for years and years. So this is a new thing, Kenneth. This has nothing to do with any current subscriptions you have. I don't know what you have, but this is a separate thing. It's a new thing, right? Yeah. So the beat reversal indicator comes with the live webinars as well. Cool. Excellent. Again, guys, I just want to make sure you understand this is a trend following big picture trade. Yes, we will manage the range. What does that mean? Let me quickly show you. So we will manage the range together on this. So just so you guys know what that means. And I think I only have like 1 or 2 minutes left. So I'll hand it over to Jeanette in 1 second. But basically, we will manage the range, right? So this is the long-term range of bonds. So we will buy low and sell high, basically, right? So we will do that, but the point is to remain in this trend. Does that make sense? So I just don't want anyone to send us a nasty email, like in 5 minutes from now or over the weekend, say, oh, this shit doesn't work, excuse the language, where are the trade alerts? That's not what this is. This is a trend following thing to make sure we stay in the trend. And so it requires a lot of economic big picture data points and analysis. That's what I do for this. So who's in with us? I see a lot of orders coming in. Give me a quick yes if you just bought this. I see a lot of people getting in here. Cool. Really, really good. All right, I know I got to go here. I'm going to hand it back over to I'm going to hand it over to Jeanette. Yeah, and if you are going to send me a nasty email, just don't. Just don't. I'm just trying to show you some data. Anyway, thank you guys. Thank you, Jeanette.